Welcome to Put Path, episode 5. Today we're going to be going over how to ladder your trades and how to choose optimal days to expiration and the logic behind these decisions. So, when do we trade? Typically, what we'd like to do is one trade per week per underlying. So we have 12 underlyings, so that's going to be opening up 12 trades a week. Typically use 28 days to expiration. So what we're wanting to do is rotate trades. So we're closing out one trade and opening up the same underlying trade each week. Sometimes we might stretch that out to 32 days if we get a favorable setup earlier on in the week. But typically we trade on Friday and we get that 28 days to expiration. Now, 28 days to expiration is important because you have a quicker gamma benefit that starts to kick in. You have the theta decay or time decay, which is the extrinsic value starting to move more rapidly towards zero. This typically starts to kick in about 28 days to expiration until the days to expiration goes to zero. So as the time decays, the option spread becomes less valuable. So when we buy it back for 1 cent or 2 cent, it's very cheap and you maximize the profit of that spread. So we're going to go over Greeks. We're going to go over gamma, delta, theta, things like that in different episodes later. But for today, we're just going to focus on opening up the trade, what laddering is. So you can see on the screen here, I've got my Tasty Trade account open, and we're looking at a few symbols, but the one I wanted to focus on first is XLU. So you can see I've got 3 trades open. Typically, I'm going to have 4 open, but I don't have all the trades in this one account on the screen right now. It's actually, there's 5 weeks that are in play. So November 7th, November 14th are on the screen. The 21st and the 28th are in one of my other accounts, either Robinhood or Fidelity. And then December 5th is the trade that I just opened up today. So you can see in that third column what the days to expiration are. So today's November 7th. So 0D means 0 days to expiration. That means it's expiring today. For December 5th, that's 28 days to expiration. And then for November 14th, it's 7 days to expiration. So a couple things to notice here that are very important. The stock price has gone up 0.29% today, which is fine. The percent profit and loss is in that fourth column. So the percentage profit and loss for today expiration is 86.1%. That's pretty much guaranteed to be a winner. Stock price currently is at 88.72. And you can see we've got a spread from 87 on the sales side, and we bought the 82 as protection. So unless something very bad happens with XLU, that's going to be a 100% winner. As you know, we've got a 2 cent buy trade in our open orders. So either that will execute or I'm going to have to go in and make sure that that trade closes out before expiration today. So the reason I'm showing you this is to illustrate the concept of laddering. So the way laddering works again is we want to open up one trade a week, and then we want to close one trade a week. So that what that does is it preserves your capital and it smooths out your buying power reduction. So as one option expires, it frees up capital to place another 4-week trade. Your trading platform is going to compute your available capital to trade. It's also known as buying power. If you don't have enough buying power, then the platform, the app, the brokerage will not allow you to make another trade. So each trade is going to eat into your buying power for The trades that we do here, a one lot for a 5 wide trade is going to take up $500 of buying power. In this case, what you see on the screen, these trades are taking up $5,000 of buying power each. So the other benefits of laddering are this. Laddering helps protect you and provide a certain level of protection as the stock market goes down or the underlying price goes down. That's because as the option moves towards expiration, even a sharp move down is not going to hurt you as much as a sharp move down when you just open the trade. So let's take another example. You look at SMH. SMH has got a sharp move down today. It's down 2.7%. Now, I have 3 trades open, one for November 14th, one for November 28th, and one for December 5th, which I opened a couple of days ago. The percent profit and loss for the November 14th trade is 83.6%. The percent profit and loss estimated for the November 28th trade is at 230%. And then for the December 5th trade, it's at 130%. Now, if you've been following the put path for any length of time, you know that that 230% is kicking off a red flag, and we need to go and close that. So I'm going to do that after this episode. But it gives you a sense for, depending on what your sale option put price was, you can see here we've got one for 295, one for 325, and one for 320. The current price of SMH is 341. So it's getting closer to that 325. If it continues down 16 more points, it would breach that 325. So therefore, according to the options pricing model, we're in a danger zone here with that November 28th trade. So the reason I bring this up, even a 2.8% move down doesn't impact the profitability of that November 14th trade that much. We're still at an 83.6% profit. So as these trades move 2 weeks out, 3 weeks out, the value is moving very close to zero. So you can see here the November 14th trade at 295 is valued at 55. The November 14th trade at 290 is valued at 50. So this trade has only got 5 cents of value right now. So time works for you. The longer the trade is out there and the longer it stays above your strike price and the higher it stays above your strike price, that trade is going to move quickly down to zero. So when do we open trades? So throughout the week, I'd like to look for trades in underlyings that are going down. Now, this seems counterintuitive, but you want to open the sale of your put into weakness. That's how you make the most money. That's the safest way to do this. When everyone else is selling the underlying and has a bearish view, then you take the opposite side of that trade. Now, why do you do that? Well, when you sell a put, it's a neutral or bullish position. Now, you're opening up a sales option. That sales option is your profit driver. So when you sell a put, that's going to be the top end or the top value in your put credit spread. Underneath that higher value, you're going to buy a put for protection. So between these two options, that's called a credit spread. Credit spread is defined that way because the money is credited to your account upon trade execution. If everything goes well and it's a winner, then the money remains in your account. If it's a loser, then you have to pay back a debit to buy it later and close it out, potentially at a loss. If the value of that spread goes up, When you buy it back, then you are losing money on it. We typically leave winners all the way until expiration, except for that 1 to 2 cent buyback trade that allows us to close them out with a small debit before expiration in order to avoid assignment risk. And I'm going to go into that deeper in a future episode. So, how does the calendar look? Monday to Thursday, we typically wait for the underlying to drop 1% in a single day. That's a key threshold. So once that 1% drop occurs, that's when you start to place your trades. The 1% drop typically correlates with a 5% or more increase in volatility. When volatility increases, the price of the options increase. Therefore, it's advantageous to sell those options. Now, when we have that 1% or more move to the downside from Monday to Thursday, we go in and we put an order for the credit spread. And why do we do that? Because in practice, once that volatility goes up and the price of the underlying goes down, you're able to sell options that are farther out of the money. So you have more safety margin. Because when you're selling the position, again, you want that price to be as high as possible. So you're going to be able to open up a position that has more safety margin and the value of those options are higher. So when you sell high during the week, that puts you in a profitable position with a greater probability of profit. Now, the technical probability of profit that we still shoot for is that 85% or minus 0.15 delta or 85% probability of profit or chance of profit, depending on which app you're using. But it's all the same thing. 85% probability of profit. 5 out of 6 of these trades should be profitable for you. So if you don't see that setup from Monday to Thursday, on Friday, you want to put the trades on for the balance of those 12. So say that you were able to trade during the week 5 of them, then the other 7, you'd go ahead and put the trade on for Friday. Even if the value is up on Friday, you still go ahead and put the trade on. So what I'm going to do is I'm going to post my real-time trades during the week, and that's going to be available to all of those who have a Put Paradise membership. So what you'll be able to do is set up a real-time notification. You'll get a ping on your device, and you'll be able to set up a trade just like I've set up the trade. So I monitor volatility throughout the week on these 12 underlyings. And when I put the trade out there, it will notify you and you can place a similar trade with similar pricing and get similar results. So hopefully that helps. Again, this is how we ladder. The laddering concept where you're placing one trade each week at that 28-day cycle. One trade rolls off, one trade rolls on. You're able to preserve your capital. Second thing to look at again is the days to expiration. Keep it right at that 28 days. And then also what we want to do is make sure that we're looking for favorable setups during the week. So we want to have that 1% drop, and then we're able to make trades that are more favorable in our probability of profit. All right, hopefully that makes sense. Stick with me, and we're going to move to episode 6.